So if there's 11,000 call options, what's the dealer's position on that then? What's the dealer's position? Well, they normally own those call options, don't they? So the dealer's normally long the call option, and obviously therefore the call option itself isn't the most important piece of information for us, but obviously if there is any dealer hedging positions on that, obviously the negative gamma, if the price is above, they've got short anyway. So when those options come out, there's going to be a possibility that obviously the price may go buy side and bounce. So when the option comes out, depending upon the dealer's position, there may well be this opportunity to buy side bounce. Because obviously if the price goes above, but that's only if the price is above 42.50 and the dealers have got that short hedge gamma against that position. Now obviously if the dealers have gone long calls, which is unusual, for the dealers are very rarely going to be short calls. If the dealers are going to be very unlikely to be short calls, then obviously if they were short calls, then they would obviously be incredibly long stock and would see a very large sell-off from that price. But so that doesn't make an awful lot of sense. So if we look at the puts options, we can see there's not a lot of puts here at 42.50. So there's not going to be much of a buyback, is there? Because obviously what's the dealer's position on a put? If the price is below, the dealer is going to be short stock. So when that option expires, that put option is going to obviously require the dealer to then buy the stock back. And again, based on an expiry, guess what the dealers are probably going to be doing? They're buying stock. So now it doesn't matter whether it's a call option or whether it's a put option, the dealers are buying stock. Kind of a bit strange, isn't it, when you think about it? That's sometimes what happens, isn't it? When you think about these ideas, especially when there's a big option level. A big option level. Now remember, the stock would have to be below 42.50 for that big trade there to take place. Now obviously, it isn't below 42.50, so there isn't a big trade. So this is one of the big problems, isn't it? This is one of the big problems that we've got. Because the stock isn't at that price. So when we're looking at these ideas, when we're thinking about these processes, guys, one of the things we're always looking at is that 1,500 hours each day, for example. We want to draw, especially on a Wednesday and especially on a Friday of the previous week. We want to get that trade line on our charts because there's usually going to be a possible buy pop on those prices in those areas, especially at that point in the charts. So it's something we start paying attention to, especially if we are below a big put option level. And unfortunately today, we're not going to get a good example of it because we're not below a big put option level. The put options that still have massive volume are the options at 42.30s, 42.25s, 42.20s. So there's a big series of options at 42.25s, 42.30s, those kind of areas. And obviously the biggest volume starts kicking off at 42.30. So obviously we would have to drop significantly down to 42.30s for that volume to really kick off. But what we're saying is, if the price is below that line at expiry, the New York cut, the price is below that, expect to see a buy opportunity. Expect to see a buy opportunity down in here. And that's what we're going to be watching, obviously, as we go through today's markets. Make sense? Which makes a lot of sense. A lot of put options.